In every boardroom, one question defines the balance between ambition and survival. How much risk are we truly willing and able to take? That's the essence of risk appetite and capacity. The twin pillars that define how far the organization can go without losing its control. The world is unpredictable. Market shifts overnight. Technology evolves faster than policies. And new threats emerge every quarter. Boards today don't just need to chase opportunity, they must calibrate how much uncertainty they can absorb in pursuit of it. That calibration happens through a structured lens. Its capacity, appetite, tolerance, limits, and residual risk. Welcome. This is your host Savit Vittal Salian. We'll now go into part 2 of this taxonomy series. For this specific video, we will cover risk appetite and capacity. This is our agenda for this series. For this video, this is the topics that we will touch base on. So, in every boardroom, one question defines success. How much risk are we truly willing and able to take? Now, risk capacity sets the outer boundary. That is, how much risk the organization can absorb and still stand strong. Risk appetite is the intent, how much risk we choose to take in pursuit of growth. Risk tolerance defines the safe operating range, and risk limit sets the guardrails that keeps us there. Inherent and residual risk shows what we face before and after the controls, revealing how much risk we consciously accept. Emerging risk reminds us that tomorrow's threats are already forming today. And concentration risk warns us against putting all the strengths in one place. Together, these define how the board balances its ambitions with endurance, thus turning risk into strategy and not a surprise. Let's go deeper into each of this topic. Welcome again. Risk capacity. It's a maximum level of risk an organization can assume based on its financial strength, its resources, its skills, and its resilience. Example, a bank's capital adequacy ratio determine how much credit exposure it can take today. Can be used to establish upper limits for financial risk, could be credit or liquidity risk. It can be used to support regulatory compliance or guide business expansion planning. Can be used for stress testing for worst case scenario. So, risk capacity defines the maximum level of risk that the organization can sustain based on its financial strength, its resources, and its resilience. Risk appetite. This is the amount and the type of risk an organization is willing to accept in pursuit of its strategic objectives. Example, a fintech accepting higher cyber risk to accelerate its digital innovation. It can be used by board level risk appetite statements definition. It can be used for that. Or it can be used for alignment of strategic goals with risk taking, or for setting thresholds for key indicators, could be KRI or KPIs. Can be used for communicating acceptable risk levels across its business units. So, a risk appetite represents the amount and the type of risk the organization is willing to take in pursuit of its strategic goals. So, that's risk appetite. Risk tolerance. It's the acceptable level of variations in outcome related to the organization risk appetite. Example, a bank can set risk appetite of non-performing asset to 2% or less, but with a tolerance of plus or minus 0.5%. It can be used to define operating thresholds for the metrics, or can be used to trigger escalation when breaches occur, or to translate broad appetite into actionable limits. Can be also used to support continuous monitoring in its dashboards. So, risk tolerance sets the acceptable boundaries around risk appetite, thus ensuring deviations remain within the safe limits. So, that's risk tolerance. Risk limits. This is the quantitative or qualitative boundaries imposed to ensure risk remain within the tolerance level. Example, a maximum of $5 million exposure to a single counterparty. It can be used for credit risk management, like looking for the loan concentration caps, or for cyber risk, which is example like maximum downtime of a critical systems, or for market risk, what is your daily trading loss limits, or vendor risk, example like no more than 25% dependency on one supplier. So that's your risk limit. So risk limit establishes concrete thresholds, quantitative or qualitative. This is to prevent risk exposures from breaching the tolerance level. Residual risk. The level of risk that remains after all the controls and mitigations are applied. This is the level of risk that remains after. That's the key. After all the controls and the mitigations are applied. Example, despite firewalls and IDS, the residual risk of insider data theft would still exist. This can be used to report net risk exposure to the management, or justify the risk acceptance decisions, or help to prioritize future risk treatments, or it can be used to support cyber insurance underwriting. So, residual risk is the remaining risk after all the controls are applied, thus highlighting exposures that the board must consciously accept. Inherent risk. This is the level of risk that exists before any control or mitigations are applied. Before. Example, fraud risk in online banking before implementing the two-factor authentication. Use cases, it can be used to establish the baseline risk exposure. It helps to support audit and compliance assessments. It helps to compare against residual risk for control effectiveness, or to identify high risk business areas. So, inherent risk is the natural level of risk before any controls or mitigations, providing a baseline for board's oversight. Emerging risk. These are newly developing or evolving risks that could impact the business in the future. Example, AI model bias leading to regulatory fines. It could be used for scenario planning for new threats or enhance resilience and adaptability or support innovation risk management. It could also be used to report to regulators and board on future outlooks. So emerging risks, these are new or evolving risks like AI or climate or geopolitics that could reshape the organization's future risk profiles. Concentration risk. Well, overexposure. This is overexposure to a single risk source. Could be a vendor or a sector or a geography that could cause disproportionate impact to the organization. Example, 70% of IT infrastructure outsourced to one cloud provider. This is a classic case on concentration risk. It can be used for supply chain or vendor diversification. It can be used for credit profile, portfolio distribution, or for data center redundancy planning, or can use for strategic risk mitigation. This is to avoid single point dependency. So concentration risk is having an over dependency on a single source that could create disproportionate impact. Having this visibility or knowing about this is one of the important parameters. A critical point for planning your strategy around this. So, if I summarize it, let's start from the top. Risk capacity. It's the outer boundary, the maximum risk the organization can bear given its capital, liquidity, and resilience. It answers the question, what can we afford to lose and still stay strong? Then comes risk appetite. This is not a number, it's a statement of intent. It reflects how much risk leadership is willing to pursue to achieve its goals. Too little appetite and the innovation dies. Too much of it, the governance would collapse. Risk tolerance, well, this translates that philosophy into operational limits. The safe corridor within which the teams can operate. It ensures daily decisions don't drift beyond the appetite set by the board. Next is risk limits. These are guardrails, thresholds that prevents exposure from breaching the tolerance level. They turn abstract appetite into measurable boundaries. The residual risk and inherent risk tells the board what remains before and after the controls are applied. Inherent risk shows the raw exposure, what we face in a world without safeguards. Residual risk shows what's left after the defenses are applied, the portion we consciously accept as the cost of doing business. But the landscape keeps changing. And that's where emerging risk comes in. They are the unknown. Could be artificial intelligence bias or climate volatility that reshapes the organization's future profiles. The board's job is not to fear them but to anticipate them. And finally, concentration risk. It reminds us that over resilience on a single vendor or a product or a single market can turn success into vulnerability overnight. Diversification isn't just a principle of finance, it's a governance imperative. In the end, risk appetite and capacity aren't static documents, they are living compasses. They align ambitions with endurance, growth with control, and innovation with accountability. Because the organization that understands its appetite doesn't fear uncertainty, it manages it, measures it, and masters it. With this, we have come to the end of part 2 of this series. We'll be moving on to part 3, where we'll touch base on control and assurance. I'd like to thank you for the time that you've invested here. This is your host, Savit Vittal Salian. Namaskar.